Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hello, James.
Good morning, Jim. How are you?
I am good. And for our listeners, welcome to another podcast of Enlightened Wealth Strategies.
Yes, indeed. It's been a while.
It has been.
So I hope you had a nice summer.
We did. It went by too quick, though. Wasn't too bad overall.
Go anyplace fun?
Just to the beach a few times. Tried to get away. Didn't work out too good, but hey, got away for a few days. That's good.
All right. Glad.
How about yourself?
We did the same. Took a few days. Took a few, a little bit more than that here and there. Well, you have to take some breaks.
There you go.
Recharge the batteries. So now we're here. We're back to do another podcast, and we have a special guest that you happen to know.
Yes, we do. Today we have John Edwards joining us from Allaris. He is entrenched into the 401k market.
Which is one of your specialties.
Well, I don't know if it's a specialty.
No, it is. You're more of an expert in it. Stop being so humble.
John, are you there?
I am here. Thanks
Welcome.
for having me, guys.
Same.
Hello, John.
Hello. How are you?
We're doing well, and we welcome you here. So I'm going to let Jim take the baton here.
Oh, no.
Yeah,
Does that mean you're going to have me ask all the questions?
Yeah. You will ask the bulk of the questions since, as I said, this is your area of expertise.
Well,
we have another expert.
Out.
So we have multi-experts here on the air.
He's actually better than me. I'm impressed with his knowledge.
All right. Well, that's why he's here, so that we can learn more and our listeners
can learn more.
Exactly.
John, why don't you get started by just first giving us a little bit of background about you, how you got started and where you are today.
Sure. So kind of an interesting career path, I would say. Right out of college, I found myself at New York Life, ended up learning the retirement business from a gentleman named Rich Cawthorn, ran a really successful practice. Did a quick stint over at another insurance agency before I had an external wholesaler from BlackRock actually connect me with a firm that was looking for somebody to run retirement. So went over there, we grew the retirement practice, and was looking for a change. Happened to have a conversation with the individual who covered me for Aspire at the time. And that spun into him actually giving his 2 weeks notice, and the CEO of Aspire gave me a call, and that's how I made the jump to the dark side of record keeping.
Okay. How long have you been doing record keeping?
Oh, so I started at Aspire in 2017. So I've been on, it was Aspire, PCS, a firm called IPX Retirement, which was focused on the non-qualified segment of the market. And then I've been here at Allaris now for coming up on 3 years in May next year.
That much time's gone by already? Wow.
Yeah.
Because I've known you back from IPX days. All right.
That's right.
Well, it's already 8 years if we do the math.
Yes.
Well, being a CPA, I can do that occasionally. So, John, tell me, because I really don't know very much about. I mean, I know a little, but a little to be dangerous, I suppose. Record keeping, that's what you do in the 401k plan and retirement plan area. What does that involve?
Yeah, and to be fair, Allaris, we are a full service record keeper. So we do both what we call bundled and unbundled retirement plans, where we can serve either as just the record keeping component or record keeping and administration. And because we're a bank, we are also serving as the named trustee in pretty much every instance. So on the record keeping side, think of that as the way I describe it as the boring gear wheelie type stuff that makes a 401k plan run. So website, statements, processing transactions, that sort of thing. How everybody interacts with and touches their 401k. That's the record keeping component.
Now, for the most part, John, I know with the 401k, there's 5 primary components in order for it to function. You have to have the record keeper, you have to have the custodian, you have to have a third-party administrator, you have to have fund managers of some type of vehicle for investing in, and then you have to have usually an advisor that's attached to a plan. Now, there's other areas that have been coming along since I gotten into this back in 2000. Well, actually, my first plan I wrote was in 1998. But 2004 is when I really started focusing in the 401k arena. Tell me, or let our listeners know, like, what functions of Allaris, when you say bundled, I'm assuming you're doing custodial, you're doing the record keeping. Are you also doing third-party administration?
Yes, sir. Yeah. So, and that third-party administration, that could be just standard, TPA, where we are outsourced, but the plan sponsor still maintains the liability and has to approve transactions and distributions. Or we can take on a 316 component where Allaris is serving as the fiduciary for approving transactions, distributions, loans, so on and so forth.
Okay. With that being said, now a lot of our plan sponsors and or listeners, they would be curious, I guess, what makes Allaris, I guess, different than Empower or Voya or Principal.
Or the payroll.
Or
groups.
the payroll groups like ADP and
right.
Paychecks and them.
Well, so it's a great question. Being that it's 2025 and everyone's walking around with enough computing horsepower in their pocket in the form of a cell phone to send a man to the moon or woman to the moon. Payroll integration, which used to be the big ballywick for, the big payroll providers, is really something that pretty much every firm these days has. So, we have connectivity with, ADP, Paychecks, Paylocity, Paycor, you name them, right? We have connectivity with them. So in that sense, not much of a difference there. But the big delta, I would tell you, is that Allaris, as a bank that owns also on the record keeping side, we do not manufacture investment products like so many of my competitors do. So what we bring to the market is a full open architecture solution where we don't care what investment options the plan sponsor selects, right? We are hired to do a service or services if we're operating in a bundled capacity. And there's really no conflict there as far as what the underlying investment options are in the plan.
Okay. That's awesome. So let's back up a little bit, because there's been a lot of changes in the 401k industry, especially when we start with the Secure Act 2.0, and then we're getting into language of, and people are hearing acronyms of PEP, MEP, and a few other things. How about if we sit back and try to decipher some of this lingo for our listeners so that they can better understand what a PEP is, what a MEP is? And I know the language, they're acronyms, but like a multiple employer plan or a pool.
Employer plan.
Thank you.
You're welcome.
So that was scripted, by the way, for everybody at home. So that's great. But what I would say is we probably want to take a step further back and ask ourselves why, now we have so many new acronyms, right? So MEPs, open MEPs, pooled employer plans, all of it really boils down to this. And I think if you look at it from the government's perspective, right, we're all sitting here, I'm sure you guys have talked about this before, where it's clear that Social Security, without any type of reform, is going to run out of money at some point, or there'll have to be austerity measures. So the government basically looked at that and said, or the Congress looked at that and said, hey, we got to do something about this. We need to have every single person who's working start to save for their retirement and try to drive participation in these plans up. So what essentially Secure Act 2.0 did was allow for for companies to, join together, forcing, requirements like automatic enrollment, auto-escalate to get people really saving for retirement. And some of the outgrowths of that was the creation of the PEP plans, which is a pooled employer plan where traditionally speaking, unrelated employers could not come together to gain economies of scale in the retirement plan space. So it made standalone plans in a lot of instances cost prohibitive for smaller companies to set up. You can pair that with, the addition of a lot of states now are either already implementing or considering implementing, or there's legislation out there for what's known as retirement plan mandates, meaning if you're a company with over X number of employees in New York, right, 5, you have to offer a retirement plan to your employees, or you have to participate in a state-run IRA program. A lot of people don't really trust the state government, so more often than not, they're going to look to set up their own retirement plan. So they have some modicum of control and also higher deferral limits. So ultimately, I think, where the government's going with this is they want to address the retirement coverage and savings gap so that there's not such a heavy reliance for a lot of people in the country on Social Security, which is heading towards a scenario where there just isn't going to be enough money to support, those who are withdrawing from the system.
John, what are some of the advantages that small business owners would use a PEP over the traditional standalone plans? I imagine there's pros and cons to it, but what are the main advantages that you would see?
Yeah, so absolutely. There's a bunch of advantages on the pooled employer plan side. Chief amongst them is, if let's say I owned a 10-person auto body shop as an example. I know what I'm doing on the auto body side, right? No, running my business, I'm focused on that. Probably as the owner, I am also, head of, a chief, financial officer. I'm also the head of HR, right? I'm wearing a bunch of different hats. So in that scenario, in my smaller business, I don't really have the time, energy, or effort to be able to dedicate towards running a retirement plan properly. So within a pooled employer plan, essentially what you're doing is outsourcing all of that functionality to the pooled plan provider, who is then going to hire somebody, most likely themselves, to do the administration component and serve as the fiduciary on those components, so that realistically all you have to do is what you've already been doing, which is living in payroll, making sure that the deferrals are updated in payroll and that data and census information is being transmitted to the pooled employer plan on a ritualistic basis. So it enables smaller businesses to offer a plan without having to run the retirement plan.
So basically, as a plan sponsor, you're removing, what would you say, 80, 90% of the fiduciary responsibility off their shoulders and putting it on the people who are running the PEP. Is that correct?
Absolutely. And I would also say that you're removing probably 98% of the administration tasks too.
Okay. That's got to be something for our listeners to seriously think about.
Well, certainly small business owners for sure.
Yes.
So John, do they? Where do you come in that picture? So with regard to the PEP plan.
So great question. So we offer some pooled employer plans where advisors can sort of take it off the shelf, say, "Hey, I'll take that thing," or for firms that are growing, because by the way, you need to have some scale in these things. We can certainly build one for those firms as well, where the advisor firm would control, say, the investment menu. They would serve as the investment fiduciary. They would provide education and enrollment services to the plan participants, and really manage that plan sponsor relationship. But then we would take all of that workload for running the retirement plan off of the plan sponsor's plate.
Okay.
Very nice.
Yeah.
I guess, John, at this point in time, a large amount of our employers are questioning whether or not they should make some changes to their plans and how to best look at this. Now, from the aspect, I know how your plans operate as a record keeper and as me as an advisor to a plan sponsor. I could come in like the MEP that you and I had talked about that we've created. I can come in and a MEP the multiple employer plan works similar. There's some differences between a PEP and a MEP. But the multiple employer plan that I created is considered an open MEP. At the same time, though, when we're looking at these plans, have you been noticing, and I guess what I've been trying to do is educate our plan sponsors about hidden fees, revenue sharing, stuff like that. Have you been, with your record keeping system, what I've noticed is that it's an open architecture. So we can put in the pieces that a client needs or take those pieces out that the client doesn't want that particular responsibility for. And I guess where I'm really going with all this is, have you been seeing that with other advisors across the country doing the same thing?
Not so much on the open MEP side. We do a lot of business in the pooled employer plan side. But as to your question or the comments you made about, being open architecture, and the hidden fees. So we as a company do not, we don't take what we would call sub TA or 12B1 or any sort of revenue sharing payments. In the instance where, let's say, an advisor selected a fund that did carry sub transfer agency payments or 12B1 payments, and the 12B1s weren't going to offset costs, as an example, we would credit those fees directly back to the participants and the fund from which they came. So the goal is to be completely and totally neutral. But if there is a scenario where, and this used to happen a lot more often, it doesn't happen as much now, but where there might be an arbitrage play between, a share class that pays revenue sharing versus the, share class that doesn't contain any revenue sharing, that's certainly a mechanism where you could use it to lower fees potentially.
Well, before you even go there, I'm going to ask perhaps an ignorant question. I don't know, maybe not, but
no ignorant questions.
Let's go from a place where I'm putting myself in the shoes of a small business owner who really doesn't have any knowledge of all the various fees that are out there, John. So what I would want to better understand is, what are the number of fees that are typically out there in these traditional plans? And how do you counteract them by the services that you provide? And you mentioned earlier in the opening of our podcast was that there are bundled and non-bundled plans that you offer. So obviously there's a difference in those fees depending upon the services that a small business owner would need. But to help them to make a decision, we need to get them up to speed to better understand what the fees are so that you can come back and say, hey, look, these are the fees that you're paying. These are fees that are hidden, perhaps, that your employees may not even be aware of, never mind yourself. And how does that help you how does that help you to distinguish yourself in your services based on the fees that they don't know about and that you offer?
So great question. And luckily the government thought about this, albeit the solution they put in place isn't the most easy to understand, but there are requirements. So any fees that come out of a retirement plan, there's 2 disclosure documents that the service providers need to produce. One is called a 408B2. That is essentially the fee disclosure that goes to the plan sponsor. Hey, here are all the fees that are coming out of the plan and what your participants are paying for. And then there's a 404A5, which is the fee disclosure that goes to participants. So every participant needs to receive this annually. Same thing with the plan sponsor. It needs to be updated. If there's changes, those changes need to be sent out to all the relevant parties. And that actually discloses every single fee that comes out of a retirement plan. So when you mention hidden fees, they're not technically hidden, although the regulations for how these documents are created makes it so convoluted that your ordinary person can't pick it up and say, oh, I know exactly what I'm paying for.
Exactly.
Right. Mm-hmm. So really in that situation, and I do this a lot, as Jim can attest with the advisors I work with, where, if we can get our hands on those fee disclosures, we can show an apples to apples, comparison. I We'll even do it if you're looking at multiple other vendors. I can put it all on one spreadsheet, make it easy to understand. The analogy I use is if you've ever seen the movie Moneyball, Jonah Hill's character says, we have all this data and all this information, and the goal is to distilling it down to one number that we can understand. So we can take all of that, put it in the spreadsheet, show it apples to apples, and distill it down to, hey, here's the total dollar amount you're paying, and what does that look like as a percentage of assets? And it makes it easier for plan sponsors to understand when they can see, one simple number as opposed to trying to track down, fees for administration, record keeping, trusts, any, sub-transfer agency fees, what's the cost for the underlying investments, so on and so forth.
Yeah, that's what makes it very confusing. And I think the disclosures you're speaking about, I guess they came out, 10, 12 years ago, the DOL, Department of Labor. Despite the fact that it was supposed to be disclosing, it's not very clear or transparent. Never mind for the small business owner and forget the employees. They're looking at this and go, I have no idea what this is. And a lot of advisors don't. But so I like the fact that what you just described helps people to better understand it, because you're basically, as you said, word that you use, you're distilling it or breaking it down to the bottom line number and interpreting it for them, which helps them to see and then better make decisions. And that's really at the end of the day, that's hopefully what we're doing, is providing information so decision makers have information to make a good decision.
Actually, if you go back 20, maybe 25 years ago, many plan sponsors thought their 401k was free.
Of course. Yeah.
So
and
there's
now,
no fees involved at all. But they've since have grown and started to understand that there's fees. And that's why I think the MEPs and the PEPs have started to become more popular, because they realized they were responsible for the investment lineup. They were responsible for what the actual fees were. There has been a litany of lawsuits, and that's what drove Congress to try to make changes, but a litany of lawsuits for high fees that the plan participants just never knew they were paying.
Right, and it affects their overall rate of return, which affects their retirement goal.
Exactly. So
one thing I do want to jump in there and just add, though, is I think it gets lost in the shuffle of this conversation, at least over the last 10 years, about fees, right? It seems like the industry for a long time was like, how do we undercut our competition's fees? And it was this race to zero, race to the bottom. But the Department of Labor, when they brought out regulations around fee disclosure, they were also very clear that having higher fees is not necessarily a bad thing if you can justify the services that you're getting for those fees. And that justification process is what, at least in the standalone plan environment, plan sponsors need to be very cognizant that they're documenting.
And I agree with you. That's one of the biggest problems. There's never an issue with charging fees, but
but also correct me. Both of you can correct me on this point. Isn't that also contingent on the size of the plan? In other words, the dollars.
The dollars being charged is based on the size plus the amount of participants that are involved in the plan. So fees are necessary to have a plan to operate. The question is how's it rate compared to peer groups in certain categories?
Well, because the reason why I asked this question is because some years ago, when I dabbled a little bit with this, I discovered somebody that had a plan, 20 employees, and they were paying fees that were incredible, but they had one of the bigger companies. They will remain nameless. And we moved them into a bigger company, but the fees were less.
Right.
So, and they got similar, if not better, services.
Yes.
And despite that, I don't think, I think we all know that most plan sponsors are not aware of that.
Correct.
Even though all this information has come out, you're going back 25 years, John just pointed out to us the disclosure requirement that came out from the DOL not 12 years ago or more.
Exactly.
And yet it's still not. I don't get the impression it's still clear out in the industry clear. Or for business owners, and
it's still not clear enough.
Right.
It's not cut and dry, black and white, as people like to think it is. What happens is an advisor will come in, or a record keeper or a plan sponsor will sit down with whoever it is that they've been talking with, and they'll lay out the fees. Oh, this is what you're paying for record keeping. But they don't then get into the TPA fees, the management fees, the fund choices. None of that. They just lack that knowledge of what's involved. I try to, when I sit down first with a plan sponsor, I'm trying to educate them as to, you need at least a minimum of 5 components to have your plan work.
As you described earlier.
Right. That's a minimum. And then at that point in time, you have to then weigh out, how's it look compared to your peer groups of similar plans of size and participants.
And that's why I mentioned that.
Right.
And I think inertia and procrastination, which is human nature, are the biggest hurdles.
Yes.
And they just let it fall into. And the reason why I mentioned earlier too was that many of them just go with the payroll carriers, the ADPs, the Paychecks of the world, because, well, it's easy. It's always bundled. Everything's included. So it's inexpensive. And I don't have to think about it.
That's where you get into the 360 integration. And you don't have, so if an employee goes in and changes the amount that they're contributing, it's automatically reported to ADP. John works with ADP. He works with Paychecks. He works with all the big payroll vendors, so that 360 integration is what they're calling it, gives the full circle, so that the reporting and the record keeping is all one smooth, coherent process, and less issues crop from that. But there's still, even if you have 180, you're still getting a good bit covered. And what I mean by 180 is if the person goes in and changes their distribution rate, well, the head of HR has to know that in order to make the changes appropriately within the next payroll run. A lot of people are looking to cut that out so that they don't have to worry about that. But they don't even realize sometimes that it's an issue. And the reporting, when you go to file your 5500 and you have a correction that has to take place, that's...
The 5500 is the tax return that has to be filed with the IRS.
Correct.
Okay.
I'm sorry, John. We kind of cut you out there.
Well, that's okay though.
Fine by me.
No, and John, this leads me to a couple of questions too. So, size of a plan does not matter to you and what your services are. So, in other words, if it's a new plan or a small plan, maybe just starting out with $100,000 or $100 million, I don't think it really matters to you, does it?
Not necessarily, no. I mean, obviously I'm on the sales side, right? So the larger number of bodies in a plan is, better off for me. But as Jim's known me for years, right? I'm happy for, I'm happy for wins wherever we can get them.
One of the things I can safely say is that what I like about Allaris is that they don't charge as assets under management. They charge per head count.
Okay.
They do have a minimum.
Head count participants,
yes.
though. So if you got 100 employees and only 20 are participating, he's going to charge fees on the 20?
John?
Correct.
Okay. But he would prefer that we get the other 80.
Of course.
Yes.
And that's where then you have to have conversations with the plan sponsor. You have low participation. Why? Maybe you need to offer a discretionary match or a safe harbor plan. This way you won't fail testing and stuff.
Right.
And you have to look at each plan sponsor and see, okay, these are the issues that I'm seeing. Do you see these as issues? So you have to get the plan sponsor talking on what issues that they have.
Well, and let's take a step back too, because I want to make sure that listeners understand this too. Despite the fact I gave that example, there's 100 employees and only 20 are participating. They could be older employees. In other words, employees that have been working with that particular company for a long time. Because with the new rules, when I say new rules, with 401k plans or retirement plans in general, there's automatic enrollment.
Not on the plans that have been around
Right, for a long time. Okay.
Right.
Okay.
Only the new plans
that's-
as of, I think it's 2024, to start of 2024, had to have include auto-enrollment
Okay.
and auto-escalation.
Mm-hmm.
So
and
anybody else prior to that is grandfathered. Now, they can go and amend their plan documents to include that.
Okay, they can.
Yes.
But they were doing that some years ago, and then their employees would have to opt out.
Yes.
Is that correct?
Yes.
Okay.
They can still opt out today. But I like the fact this is going back to the procrastination. An employee gets enrolled automatically at 3%. They're like, oh, you took money out of my paycheck. Yeah, it's going into your 401k, but I didn't authorize that. Well, then you have to go in and change it, but they don't. They don't go back and change it.
Inertia gets in the way. It's like,
so they keep putting away then, and then they get a bump in it. Well, yeah, we had to raise it up at 1%.
But the only problem with that too, and John, we'll get back to you in a second, but is that they usually go into one of the either money market accounts or the target date funds based on their age, right?
That is true. There is what they refer to as the QDIA, the Qualified Default Investment Account.
Correct.
And it's just, most of them are age weighted. So a target date fund is based on your nearest retirement. People have created models where it's based on the person's age. And then as they get older, they're moved from one model to the next. And the target dates, they kind of go from having, if you're very young, as you get older, from having a lot of stocks to very little stocks by the time you get to retirement. Right. Maybe about a 50-50 blend, depending on the target dates.
Right. Okay, that makes sense.
Sorry, John.
No worries at all.
You can chime in anytime you want.
Well, so I'll actually piggyback on the back of that now, because we've seen a lot of new innovation in the QDIA or qualified default investment alternative space, where now you've got some target date providers that are trying to marry in purchasing units of annuities inside of the target date in order to do some guaranteed income. You've got other target date providers like my friends over at PIMCO, who essentially they have like 400,000 different glide paths inside of their target date solution, where it's going to look at all of your individual factors, age, salary, some of the other personal information that they're able to glean from the record keeping side, and put you into a different glide path. So if, Jim and I are the same age, we make the same income, we might have completely different allocations in our target date fund, based off of, how much money we've saved for retirement, what the assumptions are around Social Security, so on and so forth. So there's some new innovations there. And then, of course, leveraging what's called managed accounts, where a managed account solution will look at, not just the age data point, but also things like income, retirement savings. You can connect outside accounts so that it can have a greater weight on, like, hey, if I already have a $1 million balance at my old 401k, I can connect it in my new 401k, and then the managed account provider will give you a specific allocation that may be more conservative or more aggressive, depending on how on track you are to retire. Which I think it's a good advancement for the industry.
Now, what happens when you have a person who is conservative, but it's recommended that because of the amount of assets they have, that they be aggressive? Does anybody sit there and try to educate them on that aspect as to why they should be more aggressive? And do you find that people are willing to make that move?
So I think it's going to depend on, the advisor, right? And whether or not they're able to connect with that person. So unfortunately, we've had this retirement savings gap or retirement coverage gap for so long that the best way to rectify it, at least in the short term, is to leverage things like technology, and at least in the managed account solution, put people where they're supposed to be. When they do go through that enrollment process, it will say, hey, this is what we think you should be, but you have an opportunity to make a change if you wanted to do something else. But that's unfortunately just kind of where we are, I think, as a country, because we came off of defined benefit plans. Now you're looking at potentially Social Security, not being in a good place in the next 20 years. We got to get people saving for retirement and building up those retirement balances.
And so what you're saying, John, is it's really incumbent upon advisors like Jim and I to be able to get in front of clients and point out to them that, yeah, you have outside assets, outside being those that are not in your company 401k or other retirement plans, and looking at it on a what I say a global or consolidated basis, which is oftentimes some advisors don't. They kind of, well, I'm not advising on that, so I'm not going to talk about that. And you're doing, I think, a disservice to those clients. But Jim and I really believe that when you do any kind of planning, you really need to look at everything they have and assist them with it. So to your point, it is important to look at everything that they have. And that leads me to another question. You and I were talking about this before we went on air, is that the President Trump signed into law a new opportunity, because John is talking about how the investments are changing in the industry and what the offerings, and whether it's annuities or what have you with regard to the target date plans. But now this new law is actually opening up even wider to other types of investments that were never offered and provided in retirement plans.
That is absolutely correct. I'm a little scared about it too.
Well, let's like everything else, there's pros and cons. So let you describe this, and then let's get John's thoughts and opinions on this new law.
What you're referring to, James, is the private placement industry.
Mm-hmm.
So before when somebody got involved with the private placement, they had to be what they refer to as an accredited investor.
Correct.
They had to have so much in assets
and income.
And income.
Right.
And then you can get involved in the private placement. Now what's happening is that if somebody wants to add private placement to their 401k plan, which is what he signed into law or signed. Is it a law now at this point, or is it just pending at this point?
No, it's the legislation that it is out there at the moment. So
okay. So anyway, if we put private placement into the 401k, then how do we know the investor understands it well enough to make a decision as to invest in it? Number one. Number two, it's dealing with alternatives, crypto,
precious metals, commodities, et cetera. And that all can now be put into a 401k. And that scares me because of most people don't understand or have the ability to go and dig into whether or not that's an appropriate investment. Well, the problem is, let's just take it to before we get John's thoughts.
Look how hard it is for us to get an alternative approved to use.
Well, yes, that, but also just take it a step back. Most 401k plans are offering what? Mutual funds, which
ETFs.
are traditional investing within stocks or equities that are public companies. Right. And fixed income securities, predominantly bonds or corporate bonds or what have you.
Still comes in as a mutual fund for the most part.
Exactly. But
or an ETF.
That's what the underlying investments are.
Right.
Therefore, those are traditional investments.
Yes.
That most people have an idea what it is, but at the end of the day, they are not experts. So they do need advisors for that. Now you're going to offer this. They absolutely needed an advisor, because now the fear and concern you have is true and valid and should be validated, because now you're offering it. Somebody could turn around and put 100% into commodities.
Yep. And that would be bad news.
Exactly. John, so what's your thoughts and opinion on this possibility?
And John, before you get into that, I actually want to back up 1 second, because I enjoyed this topic. But you were talking about annuities being part of a 401k now. Have there been a lot of 401ks adopting the guaranteed side of the annuity for generating income for participants? Because usually that falls in after they retire as opposed to before they retire?
Yeah. So I listen, as far as I know from the industry, the adoption hasn't quite taken off. It's still a relatively new concept. And as you know, things move slowly. I mean, it's not long ago that target dates became a thing, but people were still using balanced funds as the QDIA at that point. So I think we're still a few years away from mass adoption.
Okay. So let's go back to the conversation that James and I started with regards to private placement.
Sure. So full disclosure, right? I mean, we're a record keeping administration. We do trust custody work. Allaris does not deal in the investment side, at least for the retirement plan component. But to that end, I think of it in the sense that 401k plans are designed to be an employee benefit plan. And so it's not something specifically for ownership, right? There's other ways you can actively discriminate in favor of ownership, not inside of the 401k. But since it's an employee benefit plan, you really need to be looking out for the lowest common denominator. And so, old boss of mine, he always used to say, like, the goal here is so that, Lulu in accounting doesn't blow herself up, right? Mm-hmm. Dumping everything into, some highly volatile fund, right? Like you mentioned crypto as an example. So, from my perspective, I think that the vast majority of participants should be in, something where like the markets work, right? So, whether it's, the stock market or the bond market or some combination thereof. And, they should probably have somebody, set it for them. Because by and large, you're going to see most participants are not paying attention on a daily basis to what's going on in the market, and is probably not in a position where they should be purchasing things that were traditionally reserved for accredited investors.
I can't argue with you on that at all.
That's the issue. I think.
Yeah. It comes down to, like, when I sit with an employee to help them allocate their funds, I'm diversifying their portfolio, giving them some large cap, mid cap, small cap, whatever their risk tolerance is. I'm creating that portfolio wrapped around multiple investments so that they're diversified, and it helps take the volatility out of the market. But before I even leave, one of the things I'm telling them is it's not timing the market, it's time in the market. And yes, the market's going to go up, the markets are going to go down. Long term, though, it's been on an upward trend, and you just got to stay put. Trying to time the market is where a lot of people make mistakes. In the 401k arena, though, I don't see people changing or making those adjustments. Once they set it, they forget about it.
Well, that's another problem too. That's the other extreme.
Right.
And that's where you and I as advisors can help people. We're not looking to time the market, but they do need to reallocate and rebalance because it gets a little heavy weighted in one area or another.
And I try to educate the clients to look at it once a year. At the end of the year, see where you are on that December 31st statement.
At least.
And then from there, if you see things getting out of whack, rebalance it.
Right.
Or give us a call and we'll talk about if you're worried or concerned about the markets.
Well, I have a number of clients that have 401k plans, and I help them and advise them on it. We look at it on a quarterly basis. Doesn't mean it will make changes each quarter, but we do review it. And because
it's important.
It is, but at a minimum, it should be at least once, if not twice a year. Yep. Exactly.
Your thoughts, John? I know you're from the record keeper side, but I know you've experienced this quite a bit with working with advisors. Do you find the trend of the participants just status quo?
Yeah, by and large. And honestly, I think that's where, target date funds and sort of these new generation target date funds, they're going to take a bunch of different data points, to set the specific glide path for participants make the most sense. Most people should just be in a target date fund. And when we see, by the way, plans that we're taking over, or even startup plans for that matter, 90% of the assets wind up in one of three buckets. It's either in the target date fund, in the S&P 500, or in the cash equivalent.
The money market. Yeah.
Mm-hmm.
Yep.
I'm not necessarily a big fan of the target date funds, but I see their value in the sense that, well, It may be better than them doing nothing at all and leaving it in a money market account.
Correct.
And, only rates have gone up recently. But if they did that for the past 10 years prior to that, they were getting nothing on their 401k plan.
Maybe you can educate me a little bit here on the target date funds. The ones that I'm familiar with, like T. Rowe Price, American funds, their target date funds are all geared towards a glide path that decreases as you get older. And they adjust the amount of stocks versus bonds portfolio accordingly. But I find that they are constantly within their fund family lineup. So are there now target date funds out there that aren't captive to just one fund family, that you can create a series of different mutual funds or ETFs to fill in or create that gap that you're looking for? Because like American funds, I find them to be very good at what they do in the large cap arena, but they're light in the small cap arena. And there's not very much mid cap. But when you're dealing with the target dates, you're only dealing with American funds, or you're only dealing with T. Rowe Price. Is there anybody out there now using multiple fund families to create the necessary? Because what I see then doing is it could theoretically enhance the returns, because where their weaknesses are over here, their strengths in other companies over here.
Yeah, absolutely. So, the one that comes to mind, I think, is FlexPath, that uses multi managers underneath. The firm I mentioned earlier, PIMCO, their target date funds are PIMCO for the fixed income portion, but then they utilize Vanguard indexes for the equity portion. So that's certainly something that's come up, and our firm as well. We can actually do the same sort of thing, leveraging technology. So we do have a number of advisors who say, hey, here are the funds, right? And here's the allocation breakdown, and I want to set it on this glide path. And so we can essentially create a synthetic target date fund by utilizing a glide path and then just allocating participants as they move towards that glide path.
Excellent. Good to know.
Full of knowledge. 90% true.
Now I just lost my train of thought.
My apologies.
So John, we're getting close to closing out. So if maybe you could give us a little bit of a summary as to when you're called in, and I'll give you two examples. If you wind up being called in, we mentioned before, you would rather have a bigger plan, but give me and our listeners an opportunity to better understand the mechanics or the steps in the process that you go through. If it is you mentioned earlier an auto body shop, you gave that as an example. So that employer has 5 or 10 people working for him. If you were called in, what would be the steps, again, in the process that you would look at to help them in the services that you offer, versus a company that has 500 people and has a plan in place?
So yeah, great question. So they're markedly different, right? For a company that's got 500 people, an existing plan, it's probably got some good size assets in it. By and large, it's the incumbent advisor or a new advisor that's coming in to take it over that's driving that process. And normally on the larger side, what we see is advisors going through a deliberative, whether it's a formalized request for proposal or request for information, or something a little bit more laid back, but they're the ones driving that process. On the flip side, what I've typically seen is that when advisors, wind up with that 5 or 10 person company, they're usually engaging me more on the front end, especially if it's a startup. And so, in my role, I work not just with advisors, but they'll also bring me in to have discussions with their clients. So if it's somebody geographically nearby, that's great. We can meet in person. If it's somebody, who would rather do a Zoom, great, we can do that too. And generally we're reviewing, what the design should be. What are the objectives? Because traditionally you see on the smaller side, it's, the owner either wants to, put the plan in place so you can recruit and retain more people, or wants to put the plan in place because his only asset is the business and needs to start saving aggressively for retirement. So how do we design the plan so that the owner can max out and get as much money into the plan as possible? So definitely two different paths. But in my role, I'm basically an extension of the advisor firm or the advisor who's bringing me in.
Now, John, does Allaris get involved with cash balance plans as well as ESOPs?
We do. So we have, we're actually the second largest ESOP provider in the country. Principal bought out Census's business. So they're, very far ahead of us. But ESOPs are a fantastic vehicle. Sorry.
Let our listeners know what an ESOP is.
Sure. So it's an employee stock ownership program. And it's a way for, a firm where, let's say it's a closely held firm, and the owner's options are, do I want to sell the business? Do I want to walk away from, the business, just wind it down? Or is there a third option? And the third option is, what if we were to sell it to the employees? Now, unfortunately, the employees probably don't have enough money to do that. So essentially what they're going to do is they're going to go out, they're going to get a valuation on the business. They're going to use the business as collateral to go borrow money from a bank to buy out the owner's shares. Depending on how they're structured, it could be half, maybe it's 20%, whatever the case may be, but buy out the owner's shares. And then all of the profits associated with it go back into this tax advantage plan and are used to pay back the loan. Once the loan's paid back, now it's the business that is the asset that all the employees own stock in. And so typically you see ESOPs, especially when they're like construction companies, right? Construction company might go ESOP and, maybe they've got, 20 guys, working. And within, 5 or 10 years, next thing you know, it's a $40 million company, because on the smaller end, they're usually S corps. And since the S corp is a pass-through entity, well, your taxation is passed through to a tax deferred vehicle. So you've essentially created a portion of the company that's tax free. So that's ESOPs in a nutshell. They're a longer process to set up. It has to be the right type of business and the right type of owner who wants to see, the business continue on, and maybe doesn't have, family that's going to take it over for him, as an example. And so there is a deliberative process you work through there. There's these things called like ESOP quarterbacks that they'll come in, help select the valuation firm, help guide the owner through that process, and then ultimately select who's going to house the assets and do the administration on those plans. And then to answer your second question on the cash balance side, we absolutely do cash balance plans. We do them a ton, especially since we're doing 401k plans. And you can cross test between the two of them. We as a firm have actuaries in-house, so we're not farming that work out to somebody else and just simply marking up what they do, which I think makes us a little bit more responsive in the marketplace.
Now, John, if anyone wants to find you, where are you located? And you mentioned geographically, if you can come to see people versus doing, a virtual call.
So, I'm going to go where the advisors are, right? So it depends on each individual scenario. I live in Rhode Island. My territory is all of New England, New York City, Long Island, Westchester County. But we follow the advisors. So, ideally, I'm not hopping on a plane to go to California with an advisor from, say Boston. But that's not to say I haven't actually hopped on a plane to go to Florida, in order to help an advisor do an enrollment meeting.
Sure,
So
you'd rather go to Florida. It's closer and sunny.
Direct out of TF Green.
Yeah.
I don't have any other questions.
I think so. So John, again, in summary, just if you could just describe the company and what you do and how you do it, and we'll close out this episode with you.
Sure. So, once again, I didn't mention this at the onset, but Allaris, we're originally a bank. We founded in North Dakota back in 1879. We've been in continuous business ever since. We actually predate North Dakota as a state. It was just a territory back then, which I think is a great feat. We as an organization, we are publicly traded, but the employees are the single largest shareholder because we are also an ESOP, which I think is awesome. And we've been doing retirement plans ever since. So predating, when 401Ms were a thing, the money purchase plans, to when the first 401ks came out, we've been doing retirement plan record keeping administration all along. And I think we're a great organization. We got some excellent staying power because the employees do sit as the single largest shareholder. And so, that's us in a nutshell.
Very good. You're a great spokesperson for your company. We really appreciate you being a guest with us today.
Thank you for having me. I appreciate it.
All right.
John, have a fantastic day, and we'll catch up to you next week because I supposedly am meeting with that client that you and I talked about.
Sounds good.
All right, John. Thank you again. Bye-bye now.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com/disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.